Capital investments. What is a capital investment? It's any investment that has an economic benefit of more than a year. For example, opening a new factory, entering a new market, acquiring another company, or researching and developing new products and services. All of these are examples of investments that would provide more than 1 year of future revenue and economic value to the business. When this is the case, the company will then record it on the balance sheet. Capital investments increase the asset side of a company's balance sheet. As those assets go up, the company is expanding its balance sheet, and if it doesn't have enough cash on hand to pay for those assets with its cash, it will use debt or equity to fund the purchase of those assets. Managers in corporate finance seek to create value by investing in assets that have high risk-adjusted returns. Before a company makes a capital investment, it needs to assess whether or not it thinks that investment will have an attractive payoff. There are two main forms that we're going to use to evaluate the attractiveness of an investment. The first is the net present value, which captures all the future cash flows of the business. The other is measuring or estimating the internal rate of return that will be generated from purchasing the asset or making the investment at a specific price. In the coming lessons, we're going to walk through net present value and internal rate of return in more detail, as they're two of the most important concepts and techniques for valuing investments in corporate finance. Let's calculate the net present value of a series of cash flows as shown above. If we graph it, it would look like this: 5 years of a forecast period for a business, followed by a terminal value, which represents all of the value of the business beyond the 5-year forecast period. Let's use the NPV formula to calculate the present value of each cash flow. We're going to take the future cash flow and divide it by 1 plus the discount rate to the power of the period number we're in. So the first $100 cash flow a year from now is worth $91 today. The $100 cash flow 2 years from now is worth $83 today. And $75 today, $68 today, and then $62 today for the fifth cash flow of $100 5 years from now. Finally, the terminal value of $1,200 would be worth $745 today. So we add all of these up and get the net present value of $1,124. That is to say, this investment would be worth paying $1,124 today for a series of cash flows as illustrated above. You'll notice that as time goes on and cash flows get further out into the future, they're worth less today. This is because of the risk and the opportunity cost associated with receiving money further in the future. It's always better to receive money today than it is later in the future. Because cash flows received in the future are riskier, we use the discount rate, which in this case is the company's cost of capital. We've used 10% as an illustrative example, and in later lessons we'll be doing a deeper dive into cost of capital. When managers in corporate finance make investment decisions, they'll be looking at the net present value of all future cash flows to determine how much they should pay for that capital investment. Terminal value is the value of the free cash flow beyond the forecast period. It's a very important concept in valuation, as it typically makes up a large percentage of the total value of a business. There are, generally speaking, two formulas to calculate terminal value. The first is a growing perpetuity formula. This formula assumes that the company operates indefinitely and that it grows at a constant rate forever. So we have to pick a very low growth rate that we believe a company can realistically grow at forever. Typically, this would be somewhere around the GDP growth rate or less than the GDP growth rate for a country. So here's the formula. It's equal to the free cash flow multiplied by 1 plus that terminal growth rate, all divided by the company's cost of capital, which is the discount rate we use, minus that terminal growth rate. The other formula for calculating terminal value is an exit multiple formula. This assumes that the business is sold at the end of the forecast period. And if we want to know what the business could be sold for, we will look at comparable companies to see what multiples they're trading at in the market. we will look at multiples of earnings, EBITDA, or revenue, and multiply by the company's terminal year earnings, EBITDA, or revenue. Let's look at an example to walk through these. If we want to use the terminal value perpetuity growth formula, we can take the $100 cash flow that we had in our earlier example, multiply it by 1 plus a terminal growth rate of 1.54%, and divide it by the company's cost of capital, which is 10%, and then subtract that 1.54% terminal growth rate. We get a $1,200 terminal value. Let's compare that to the exit multiple approach. If this company had $100 of earnings, and comparable companies traded at 12 times earnings, then we would multiply by 12 to get a terminal value of $1,200. So you can see how these two are mathematically equivalent to each other. Using a perpetual growth rate formula is more common among academics, and using a terminal value that's an exit multiple is more common among industry practitioners. Sometimes, though, you can take an average of the two or toggle back and forth between them and compare the values. Let's take a closer look at what drives value for a business, and more specifically, what can create a larger terminal value for a company. Let's dissect each of the components of the formula. Free cash flow is essentially a function of a company's overall business strategy and execution of that strategy, which generates revenue, and when taken into account with a cost structure and asset utilization rate, finally derives cash flow. So to the extent a company has a better strategy, more revenue, lower costs, and better use of assets, it creates more cash flow, which creates more value. Let's look at growth. When we look at growth, we're talking about organic growth that the business can generate itself, and ultimately what's sustainable over the long term. On the denominator, when we look at cost of capital, we're essentially saying what is the risk, or how much do you have to be compensated to make this investment, as well as looking at the current capital structure of the company and global macroeconomic factors as well. And then on the other side of the denominator, of course, we've got growth again. So this is the same as on the numerator. There are two parts of this formula that are very important to highlight: risk and growth. These are offsetting forces in the formula. To the extent a company is higher risk, it's going to have a higher cost of capital and thus a lower terminal value. But to the extent a company is growing more, it's going to have a smaller denominator and thus a higher terminal value. So there's a trade-off and there's a relationship between risk and growth. Generally speaking, high growth companies are taking more risk. So there's an inherent tension between risk and growth and the valuation of a business. Enterprise value is the value of an entire business without giving consideration to its capital structure. It's important to differentiate between the enterprise value of a business and the equity value of a business. The equity value of a business is the market capitalization, or just the value that shareholders would receive if the company is sold. If a company has debt, when it's sold, the debt has to be repaid first, and whatever left goes to the equity investors. This is why typically the equity value of a business is less than the enterprise value. When we calculate enterprise value, we are calculating the net present value of all future cash flows of the business. Or we can take the equity value, if it's already known, add any debt that the company has, and subtract any cash. On the other side of this diagram, we can calculate the equity value of the business by taking the share price and multiplying it by the shares outstanding, if the share price is known. Otherwise, we can calculate the net present value of the business, which gives us the enterprise value. Then we subtract any debt and add any cash. We'll be coming back to this diagram and this formula constantly throughout the FMVA program. We will take a deeper dive into it in our business valuation modeling course. But it's important to point out that we need to differentiate between enterprise value and equity value when we're talking about the value of a business. When assessing capital investments, managers in corporate finance will often use the internal rate of return as a way of evaluating how attractive an investment is. Looking at this diagram, starting from left to right, we have an initial capital investment, which is the negative outflow of money. Then we have a series of positive cash flows, which are the return we get from making that investment. The dotted gold line is the cumulative cash flow over time. We hit a break-even point somewhere in the middle where all of our capital is repaid, and then we have positive cumulative cash flow from that point onward. So how do we assess how attractive this series of uneven cash flows is? Well, in Excel, we will use the XIRR function to calculate the internal rate of return, which in this case, for these cash flows, happens to be 22%. So how do you interpret the internal rate of return? Well, it's economically equivalent to earning a 22% compound annual growth rate over the entire life of this investment. It's also the discount rate that can be used to set the net present value of a series of cash flows or an investment to be equal to 0. So internal rate of return is a very important concept, and we will be using it throughout the FMVA program to compare the attractiveness of different investments. Mergers and acquisitions is the process where companies buy, sell, or combine with other businesses. There are many benefits and many reasons why companies want to make mergers and acquisitions. Some of the most common reasons include cost savings, which are called synergies, by combining operations and becoming more efficient. Then there are revenue enhancements by being able to cross-sell or achieve more revenue, gaining more market share, or enhancing the balance sheet and financial resources of the combined entities. But there are also some serious drawbacks and risks when it comes to M&A. The main drawbacks include overpaying for the company, the expenses that go along with making an acquisition, and finally a negative perception or negative reaction from the market for making an acquisition. In corporate finance, mergers and acquisitions are a major form of capital investment that managers and investors have to look at very carefully and are often compared to projects and other types of capital investments that companies can make. Ultimately, companies should only acquire other businesses if they believe that it creates value for their shareholders and possesses an attractive risk-adjusted return, especially relative to other projects or internal investments that the company can make. Let's look at the steps that a corporate development team at a company that's looking to make an acquisition would go through. They would start by having a very clear acquisition strategy that ties to the company's overall strategic plan. From there, the company can set criteria that they want to use to look for certain types of companies. Criteria, for example, could include location, type of business, size of the business, etc. From there, they can go search for targets that meet those criteria. And once they find the targets that meet the criteria, they would reach out and approach those targets to have some preliminary discussions. If the targets are open to more detailed analysis, they would provide more specific data that the company can use to perform a detailed valuation. Prior to step number 5, any financial modeling or valuation work would be done on publicly available information, and after point 5, it would be done based on information received directly from the company, assuming they're open to exploring a transaction. From there, the two companies can negotiate and finally agree on a purchase price. Then there's going to be due diligence performed to ensure that the company is exactly as it's represented. And then there can be a purchase and sale contract that's drafted by the legal team and legal advisors. Finally, the financing can be put in place if necessary. And then ultimately there's the integration of the two businesses as soon as the transaction closes. So broadly speaking, this is a general idea of what a 10-step acquisition process would look like for a corporate development team. Broadly speaking, there are two types of buyers in mergers and acquisitions: strategic buyers and financial buyers. Strategic buyers are other operating businesses, and they're typically looking to expand either vertically into a new area of the market or horizontally to get more market share in the same market. They're also looking to achieve operating synergies, which can be in the form of cost savings or revenue enhancements. So really two categories here for the strategic rationale: expansion and synergy. Then on the financial buyer side of things, we're talking about private equity firms or financial sponsors. They are professional investors and non-operators. They will be looking to use leverage, which is to borrow money to get maximum equity returns and maximum IRRs. It's not clear and it cannot be generalized as to which is a better type of buyer in any transaction. Sometimes a strategic buyer can pay more because of synergies and strategic value, but sometimes a private equity firm or financial sponsor can pay more due to the leverage and the higher equity IRR that they can achieve. In either type of process, whether it's with strategic buyers, financial buyers, or a combination of the two, there are very likely to be rival bidders. The vast majority of M&A transactions are competitive, meaning there are multiple buyers for the transaction. Generally speaking, companies have to offer more than rival bidders. In order to be able to pay more than someone else, generally speaking, there are a few reasons. One could be that the acquiring company is able to do more with the acquisition, meaning they could get more synergies. There's more strategic rationale, for example. Another reason could be they're simply willing to accept a lower expected return. By paying more, their expected return becomes less, all else being equal. Or finally, they could just have a different view or a different forecast for the future that's more optimistic and therefore justifies paying more. But in any event, a competitive process will likely go to the very highest bidder. For companies that are selling into an M&A transaction, it's important to create a lot of tension between buyers to maximize the price the company is sold for. But for companies that are the buyers and looking to make acquisitions, it's important not to overpay for the company and to stick to a valuation that still provides an attractive risk-adjusted return. Let's look at the valuation process for an acquisition, and this is in a strategic buyer scenario. So the buyer would model the value of the target as a standalone, calculating the enterprise value for the business and factoring in things like revenue growth rates, margins, tax rates, working capital requirements, and capital expenditures that are needed to fund and grow the business. Then, in step 2, looking at the value of synergies that can be realized, both hard synergies, which are cost savings, and soft synergies, which are revenue enhancements. Things like higher volume, changes in product mix, overhead reductions, acquiring tax losses, improving vendor relationships, and having more capital efficiency can all contribute to synergy creation for a transaction. So once you've got these two steps, you've got the value of the target and the value of the synergies, you can piece it all together. Here's a diagram of how everything can be combined. You start with the standalone value of the target company. Add the value of the cost savings. Add the value of the revenue enhancements. Subtract from that the transaction costs to investment bankers, lawyers, accountants, and others. And then you're left with a combination of net synergies and standalone value. That can be compared to the purchase price or the consideration that's paid. And the difference between step 5 and step 6 is the value that's created. So if the consideration that's paid is greater than the sum of the components in step 5, value is actually destroyed or lost. But if the consideration paid in step 6 is less than the total in step 5, that difference is the value that's created, which is obviously the objective for the buyer in this transaction. In our mergers and acquisitions financial modeling course, we'll be looking at how to model the combination of two businesses in detail with these concepts. And ultimately, we'll be able to forecast what the expected impact is for the buyer as a result of this transaction in our financial model. There are a lot of issues to consider when structuring an M&A deal. Outside of the deal, there's the actual structuring environment that has many factors that can impact the deal. And outside of that, there's the broader macroeconomic environment that can also impact everything as well. Since this is an introductory course, we're simply going to bring up the concepts that you need to consider, and in later courses, we'll dive into them much more deeply. So in the structuring environment, there are things like the company's strategic plan and how aggressively it wants to pursue this transaction, as well as forces from competitive bidders. Whether it's a public or private company, the capital structure that the acquirer can handle, and whether or not the transaction is hostile or friendly. So all of these will factor into how intense or how competitive the deal is going to be. Looking outside of that, there's the market environment, which includes things like antitrust rules that the transaction will have to pass through, the type of financing that's actually available in the market, corporate and international laws, general market conditions, tax regimes, accounting rules, and contract law for drafting the actual purchase and sale agreements. So when structuring an M&A deal, there are a lot of factors that have to be taken into consideration, and all of these will ultimately impact how doable the deal is and affect whether or not it actually gets done. Professionals in corporate finance, whether they are investment bankers or corporate development professionals, will have to be able to navigate through all of these factors when working on a deal.